Good morning, good afternoon, good evening, ladies and gentlemen. It's a pleasure to give this AMRO keynote today. You can see the title. It's about the Genius Act, stablecoins, and Asia. There are many interesting international monetary and financial things going on in the world at the moment. There are questions about the US dollar as the dominant global currency due to erratic US policies, soaring US debt, which I show you at the upper right of this slide. These are the Congressional Budget Office's projections of the US debt to GDP ratio going out to 2025, and you can see it goes up, up, up. There are questions deriving from weaponization of the dollar, increasing use by the United States of financial sanctions. You can see their incidence on the lower right, and they go up, up, and up as well. There are questions because of the fact that renminbi internationalization is slowing, and some would say stalling out. The renminbi's reserve share has been falling now for a couple of years. The currency is used mainly in China's own cross-border transactions. The share of the renminbi in payments through SWIFT has actually been falling. And by my calculations, the share of the renminbi in payments through SWIFT and China's own cross-border interbank payment system combined appear to be flat. And there is a reluctance on the part of banks in India and in the West to participate in CIPS. Their efforts to promote local currency settlement are bearing fruit very, very slowly. If at all, CLS is the main company that provides payment versus payment settlement services, but only for the Korean won, the Mexican peso, the South African rand in terms of emerging market currencies. China's own China foreign exchange trading system designed to provide payment versus payment settlement for the renminbi does so only for the Russian ruble and a few other currencies. So exchange rate risk, settlement risk for local currencies in Asia as well elsewhere remains problematic. And now there is the Genius Act passed by the US Congress and signed into law by President Trump this summer, one goal of which is to solidify the international role of the US dollar. How might the Genius Act do this? The underlying idea is that dollar-linked stablecoins will provide a faster and cheaper set of payments rails, not only for domestic transactions in the United States, but also for cross-border payments worldwide. It will be faster and less expensive than the correspondent banking system and its messaging system, SWIFT. If this enhances the attractions of dollar payments, corporate treasurers around the world will be encouraged to maintain inventories of dollars, given their continued utility in transactions. Central banks likewise will be encouraged to hold reserves of dollars, since without them, they won't be able to act as, those central banks won't be able to act as dollar lenders and liquidity providers of last resort. So these complementarities between payments, between the activities, financial activities of corporate treasurers, the financial preferences of central banks will lock in dollar dominance. Geeta Gopinath and her co-authors have written extensively about these complementarities and the fact that some 99% of stablecoins worldwide are linked to the dollar at the moment supports this presumption that widespread adoption of this digital technology will be dollar positive. Let me review very briefly what the Genius Act entails. It authorizes issuance by banks, non-bank financial firms, and tech companies of dollar-linked stablecoins. It provides for multiple regulators of those issuers. So if they are subsidiaries of member banks of the Federal Reserve System, they will be regulated by the Fed. If they are non-member banks, tech platforms, big retailers like Walmart and Amazon, they will be regulated by the comptroller of the currency. And if they are state banks or smaller companies, they can be issued by state bank regulators, such as the very enthusiastic state bank regulator of the state of Wyoming. The Genius Act requires redemption on demand of dollar-linked stablecoins at par at a fixed value of 1-to-1. It requires the issuer to hold 100% backing in highly liquid, low-risk reserves, which in practice means bank deposits, short-term treasury securities, money market mutual funds, and what the Genius Act calls, quote, other similarly liquid assets. It requires monthly examination and annual audits of the balance sheets of those issuers by registered accounting firms, the annual audit being a more demanding process than light touch monthly examination. And it prohibits stablecoin issuers from paying interest to holders in order to limit flight from bank deposits toward stablecoins, although there may be a loophole there that the exchanges that on which stablecoins circulate and trade may be able to pay interest and obtain payments to enable them to do so from the issuer. This then creates challenges for governments and central banks in Asia, specifically and more generally continued dollar dominance enabled by dollar stablecoins mean continued exposure to U.S. policy uncertainty, U.S. debt problems, potential further weaponization of the dollar. There is the danger of currency substitution from local currencies to dollar-denominated stablecoins, and there is scope for money laundering, tax avoidance, capital control, evasion, all pointing to the question of how governments and central banks should respond to these dangers. So I will list 5 possible responses. Possible response number 1 is to do nothing, because stablecoins will not, in fact, enter the mainstream of cross-border payments. Stablecoins are not insured. Deposits with U.S. correspondent banks are insured up to a limit. Past experience suggests that stablecoins may not, in fact, be stable, that safe and liquid assets can quickly become unsafe and illiquid. This happened to Circle in 2023 when it held its backing at Silicon Valley Bank. There are questions about the singleness of money, about fungibility. Will Amazon coin be usable at Walmart? Will Walmart coin be usable at Amazon? And the correspondent banking system and SWIFT are not standing still. They are experimenting with Bitcoin and they are experimenting with blockchain and instantaneous messaging. Currency substitution may be a problem in some parts of the world, but not obviously in Asia, in emerging and developing Asia, where inflation rates are much lower than they are in Latin America or sub-Saharan Africa. Possible response number 2 is to attempt to ban dollar-linked stablecoins, following China, which banned crypto in 2021. Bangladesh has issued a similar ban. If I understand correctly, Indonesia and Vietnam do not prohibit residents from holding stablecoins, but they bar their use in payments. There are those examples, although few other Asian countries have followed them down this road. China has done this by attempting to block wallet services, restricting accounts on crypto exchanges, banning crypto advertising. But a recent study by the IMF using language, script, regional references to identify a wallet's location suggests significant stablecoin flows into China in 2024, enabled by the use of VPNs and so forth. Possible response number 3 is to issue competing local currency stablecoins. So Japan put in place a regulatory framework for yen-linked stablecoins in 2023. Singapore moved shortly thereafter, authorizing the licensing of Sing dollar stablecoins or stablecoins denominated in other major currencies. Other countries could follow, and the Hong Kong Stablecoins Ordinance of August of this year, providing for Hong Kong dollar denominated stablecoins, the expression that Alibaba and Bank of China, among others, have expressed in obtaining a license suggests that this may take off. The question is whether China is likely to bring this experiment back on shore. Its capital controls could be jeopardized if it adds China's digital ID system to renminbi-denominated stablecoins. Having to give up that information, confidentiality, will probably not be attractive to foreign counterparties. Possible response number 4 is to link fast payment systems in the region. These, of course, do not run on blockchain. They run on the same protocols as cross-border interbank payments. They're actually faster than stablecoins, which may take 5 to 10 minutes for the average user to on-ramp one fiat to a stablecoin and off-ramp that stablecoin to a different fiat. Transfers in actual bank money, avoiding the Amazon coin, Walmart coin problem, and there are 20 such systems in operation or being piloted in Asia. Linking these fast payments systems requires agreement on protocols and standards. It took Singapore and Thailand 3 years to finalize their agreement. Project Nexus, which is a project of 5 Asian central banks, might streamline this process of agreement. We'll find out in mid-2027 if everything goes according to schedule. It seems like agreement on standards and protocols is easiest among neighbors. So I show you on the right here the different regional clusters of fast payment systems from a study by the European Central Bank. There is a cluster in East Asia where links are in existence or in process, but there's only one link between East Asia and the rest of the world, namely that with India. So this would seem in the first instance something that can be done at the regional level, not so easily globally. It can't substitute easily for the global dollar. And possible response number 5 is interoperable central bank digital currencies. So CBDCs are being piloted in the region. The PBOC is in the lead. They offer speed, safety, and finality, but take-up is slow. The ECNY is hardly used at all in China itself. So if the Chinese don't use it, how can it be used cross-border? It can be used cross-border if experiments like Project Enbridge come to fruition. So as you know, Project Enbridge involves 3 Asian monetary authorities and central banks, and now 2 central banks outside the region, the UAE and the Saudi Central Bank. It works, the code works. It was developed in the Digital Institute of the PBOC, and the Bank of China reported that by July of 2025, it had processed transactions totaling $1.4 billion worth, 80% of which were in renminbi. Problem being that this is a drop in the bucket compared to what SWIFT and the correspondent banking system clear on a daily basis. And moreover, political issues remain to be addressed. Will decisions be reached by majority voting as membership expands and agreement by consensus becomes impossible? Who decides who gets to join? Will Western countries like the US be willing to join what looks like a China-led system? So again, my suspicion is that this kind of project will work to facilitate payments in the region, but not globally. So to conclude, what do I recommend? Doing nothing is risky. That much seems clear. Attempting to ban the use by residents of dollar stablecoins would seem to be limited to countries like China, where the government has strong control of the internet and of financial transactions of all. Under these circumstances, I would argue the prudent strategy is to diversify, to explore the development of a local currency stablecoin, to link fast payment systems to those of other countries, and to continue studying, piloting, and rolling out CBDCs. I interpret China as having recently taken a modest step in this direction. It had been emphasizing the ECNY and Project Enbridge up until now. It is now enabling the adoption of a framework in Hong Kong. I think other countries should be thinking similar thoughts about pursuing a diverse strategy in response to the Genius Act. So I hope that's enough to get thoughts flowing, and I thank you very much for your attention.